Hi guys, I'm Karunya Rao, and in Ideas for Profit, the spotlight is on Manappuram Finance. The divergent performance of a Muthoot and Manappuram Finance narrates a story of superior versus inferior execution in the same business. Now, last year, after the initial tailwinds of lockdown-led demand for liquidity and rise in gold prices had a salubrious impact on the entire gold financing sector, and the high tide lifted all boats. However, when the operating environment turned challenging with heightened competition from banks and a decline in gold prices, several players experienced stress. The savvy old hand like Muthoot managed to ride the crisis by just sacrificing growth temporarily. But for Manappuram, the hole was deeper. Not only did growth nosedive, but asset quality woes also surfaced, resulting in significant sale of assets under gold auction. Manappuram's substantial non-gold business, which was already under stress, faced severe challenges in the wake of the second wave of the pandemic. The good news from investors' perspective is the stock's significant underperformance. In the past 9 months, Manappuram has massively underperformed the Nifty as well as its peer Muthoot. We see tactical upside in Manappuram in the coming quarters owing to the improving macro environment, which should have a positive impact on growth as well as on collection efficiency. In addition to that, range-bound gold prices and a lot of problematic assets which are already out of the book should support growth. However, as we've always maintained, Manappuram remains a stock for risk takers. Q1 FY22 was a weak show by Manappuram as loan book degrew, led by the gold loan portfolio with its share of close to 67% in the consolidated book. The reasons were multifold. In addition to the second wave linked restrictions and impact on the informal sector borrowers, there was stiff competition in the loan market, especially for large ticket loans from banks and other NBFCs that ate away market share. To make matters worse, the correction in gold prices resulted in exceptionally high loan-to-value ratio in certain pockets. With many of these loans being short-term with maturity of 3 months, the company decided to auction the underlying gold and not wait for realization at a future date. In fact, Manappuram saw a steep decline in gold holdings sequentially from 65.3 tons to 58.1 tons and close to 4.5 tons reduction, which was due to auction. While gross and net NPAs showed little change, the asset quality picture continues to be worrisome for the non-gold business as well. Ashirvad Microfinance saw a spike in gross NPA sequentially from 2.5% to 3.6% and a steep rise in portfolio risk. The housing finance unit continued to show elevated stress with gross and net NPAs at 15.7% and 7% respectively. The vehicle finance business also continued to have high gross and net NPAs of 19% and 5.6% respectively. One might ask why even for the risk takers? Although Manappuram has a poor track record, all is not lost. The company has almost negligible troubled gold loans in the book after the fire sale of Q1 and has very few high-ticket gold loans left and is now looking to grow in the remaining 3 quarters of FY22 as normalcy returns. Although non-gold book is unlikely to grow till asset quality improves, gold loans should drive an overall mid-single-digit growth for the company. The present loan-to-value ratio of the overall book is at a comfortable 65%, and hence moderate fall in gold prices should not impact the portfolio quality much. On the liability front, the company appears well placed with a diversified source of funding. It does not have much mismatch between assets and liabilities and is sitting on cash worth 2,900 crores and undrawn bank lines of 7,320 crores. In the last 1 year, it has seen a steady reduction in its cost of funds, and as excess liquidity gets deployed, we expect margins to improve. Capital adequacy of 34% is an added comfort. Manappuram has embarked on a massive cost reduction initiative and expects to see its positive impact on earnings once the business gathers momentum. While asset quality remains a challenge, the good news is the steady improvement in collection efficiency. Unless there is a virulent third wave, we may have already seen the worst in terms of asset quality. We have nevertheless factored in higher credit costs for FY22 and a marginal reduction in FY23. Despite the troubled past, improving macros and the huge valuation discount to its peer Muthoot Finance warrants attention. While there are execution challenges, it is a worthy bet for the risk taker as the valuation discount to Muthoot could narrow as asset quality pressure wanes and growth picks up from gradual return to normalcy.